Greetings everyone, today we delve into the world of exchange-traded funds, specifically the REX-FANG and Innovation Equity Premium Income ETF, also known as FEPI, and the JP Morgan NASDAQ Equity Premium Income ETF, or JEPQ for short. Now let's start with FEPI. This ETF sets its sights on capital appreciation and current income, and it does this by investing in 15 equally weighted big tech stocks and writing covered calls. It's a bit like having 15 eggs in your basket, each with a different flavor, and it's actively managed, which means there's a team constantly monitoring and adjusting the portfolio to meet its objectives. On the other hand, we have JEPQ, an offering from the financial giant, JP Morgan Asset Management. While the specifics of how JEPQ operates may vary, it's safe to say that it carries the weight and reputation of JP Morgan, a global leader in financial services. With this brief overview, you now have a basic understanding of what each ETF represents. Now let's delve deeper into the pros and cons of each. Starting with REX-FANG and Innovation Equity Premium Income ETF, or FEPI. Now FEPI has an intriguing approach to investment. It aims for capital appreciation and current income by investing in 15 equally weighted big tech stocks. This is a promising strategy as the tech sector is known for its dynamic growth and innovative prowess. Furthermore, FEPI employs a strategy of writing covered calls, which can generate additional income, particularly during periods of sideways or slightly declining markets. However, as with all investments, FEPI comes with its own set of risks. First, there's the risk of sector concentration. Since FEPI primarily invests in big tech stocks, any downturn in the tech industry could significantly impact the fund's performance. Next, we consider liquidity risk. In certain market conditions, it may be difficult to buy or sell FEPI shares without significantly impacting the market price. This could lead to less optimal execution and potential losses. Derivatives risk is another concern. While covered calls can provide additional income, they can also limit the fund's upside potential. If the underlying stocks perform exceptionally well, FEPI may not fully participate in the gains because of the call options it has written. FEPI also employs a high portfolio turnover strategy, meaning it frequently buys and sells securities. This could result in higher transaction costs and possibly lower returns. Finally, it's important to note that FEPI is a non-diversified fund. This means it can invest a larger portion of its assets in a single issuer, making it more susceptible to the financial success or failure of those issuers. Moreover, FEPI is relatively new, and this lack of a long-term track record may deter some investors. While FEPI may offer capital appreciation and current income, it's crucial to be aware of the associated risks. As always, it's essential to do your due diligence and consider your risk tolerance when investing. Now let's shift our focus to JP Morgan NASDAQ Equity Premium Income ETF, or JEPQ. This financial product, brought to you by JP Morgan Asset Management, is a popular choice among investors, but as with any investment, it's not without its pros and cons. First, the advantages. JEPQ is managed by an industry titan, JP Morgan, a name that carries weight in the financial world. This means you're investing in a product backed by a company with a wealth of experience and a solid reputation. Furthermore, JEPQ, being an ETF, provides a level of diversification, offering exposure to a broad range of NASDAQ-listed companies. This can help spread out risk and potentially smooth out returns over time. However, it's not all sunshine and rainbows. JEPQ, like all financial instruments, carries its share of risks. Market volatility can affect the value of your investment, and if you're not careful, you could end up with less than you put in. Additionally, there's the issue of tax penalties. If you make withdrawals before you reach the age of 59 and a half, you could face penalties from the taxman. This means JEPQ might not be suitable for those looking for short-term investment opportunities. Another key point to consider is the necessity of personalized advice. JP Morgan Asset Management emphasizes that their communication is for informational purposes only, and not a recommendation for specific investments. This means that it's crucial to seek personalized advice before making financial decisions, to ensure that JEPQ aligns with your individual financial goals and risk tolerance. Finally, there's the matter of charges and expenses. Although not unique to JEPQ, these costs can eat into your returns over time, so it's important to factor them into your investment decision. In conclusion, JEPQ, like any other investment product, comes with its own set of advantages and challenges. It's crucial to weigh these factors carefully to make an informed decision. Remember, investing isn't a one-size-fits-all proposition. It's about finding the right fit for your financial goals and risk tolerance. Having looked at both ETFs in detail, It's time to sum up our findings. Let's start with the REX-FANG and Innovation Equity Premium Income ETF, or FEPI. This fund aims for capital appreciation and current income by investing in 15 equally weighted big tech stocks and writing covered calls. It's actively managed with a gross expense ratio of 0.65%. However, investors should be mindful of the risks associated with sector concentration, liquidity, derivatives, call writing strategy, high portfolio turnover, and the fund being non-diversified and new. On the other hand, we have the JP Morgan NASDAQ Equity Premium Income ETF, or JEPQ. This fund is part of JP Morgan Asset Management's offerings and is distributed by JP Morgan Distribution Services Inc. The fund, like any other investment, carries risks, which investors should consider carefully. Market risks, charges, and expenses are among the factors to keep in mind. Both ETFs offer a potential source of income and capital appreciation, but they have distinct strategies and risk profiles. FEPI's approach of investing in big tech stocks and writing covered calls could be appealing to those seeking exposure to the tech sector and income generation. On the other hand, JEPQ, backed by the financial giant JP Morgan, could be a fit for investors looking for a blend of income and growth opportunities within the broader market. However, it's essential to remember that these fund strategies and potential returns come with their own set of risks. FEPI's sector concentration could lead to higher volatility, while JEPQ's broad market approach might not offer the same level of potential returns as a more focused strategy. Investing in ETFs, like FEPI and JEPQ, can be a viable strategy. However, always remember to consider your financial goals, risk tolerance, and investment horizon. Until next time, remember to subscribe, like, and share to help with the YouTube algorithm. See you in the next one. Ciao.